Hey, everybody, welcome to our Trading Essentials, Tom's Trading Essentials. This is part two. Glad to have you here. If you just joined me, we did a part one on this yesterday, and we talked about everything from all about calls, all about puts, stock selection, and I gave away a free app. I'm going to be sharing that with you again today. A lot of stuff going on here today. I mean, on the screen, I've got GameStop and AMC. That is the, these guys are seeing second signs of life thanks to the Reddit community. There may be some opportunity in one of these two stocks today on something I'm going to be talking about. So excited to have everybody here. Guys, real quick, just want to let you know, our channel here, it has grown immensely. We are excited about what it's done in the options community. A lot of it's options, a lot of it's cryptocurrency. We're going to be doing both. Since we hit a new milestone last weekend, I am live streaming every day this week, Tuesday, Wednesday, Thursday, Friday. Also, I've got a free app I'm going to be talking about here in just a few minutes. So stick around. I'll tell you what you got to do to download it. And there is nothing required on this app other than an email address. And that's pretty much it. So we're going to get into that. We're going to talk about selling options premium. So much more I've got to do over the next hour/90 minutes. So hang tight with me here. Also, realize this. You feel free to chat with us, all right? And each other for that matter. I have super chat donations set up. So if you super chat donation to me, I want to thank you in advance. And I've got the bell there ready to ding it when we get super chats. All of this money, all the profits from this channel go straight to charity. That being said, let's go ahead and get moving here. So I'm going to switch gears, and I want to first get through the quick housekeeping. I'll leave this on the screen for just a few seconds. This is our disclaimer. Keep in mind, you can read this thing in its entirety. All you got to do is hit pause on the recording. All right. And you can pause the live stream for that matter. But I'm just going to mention two quick things before we continue. Number one, stock options and cryptocurrency have large potential rewards, but also large potential risks. And number two, I'm not a money manager. I'm not a personal investment advisor. I'm here to show you how it is that my team and I spot opportunity and create alternative risk trades other than simply buying and going long. I do that through pattern recognition. Now, I look at a couple of different patterns, but one thing I want to let you know about patterns is that there are no guarantees with patterns that I look at, algos that I use, or anything else out there. So keep that in mind. What I do is I look at repeatable patterns, and that's the side that I'm going to trade on when something comes my way. All right. So for those of you just joining me, you've never heard of me before. I'm a 30-year veteran in stocks, options, commodities, currencies. I pretty much traded it all. I began my life on the floor at the American Stock Exchange. Co-founded a company called Optionetics. We had at the time over 300,000 students pass through these halls. And this was when we did seminars, live seminars, where we went to hotels, convention centers, etc. Since then, the whole world's turned upside down, even before the pandemic. And we've done more live streams than anything else. I've authored several books. I've been on TV once or twice, many more times than that. And I am currently the founder and editor of TomGentile.com, Optionetics.com, and Tom'sOptionTools.com. All right, so why are we doing this? Well, we're doing live streams all week long because we hit a milestone on our YouTube channel. 20,000 subscribers, 1.1 million views all time. I'm not a Kardashian. Sorry, I can't get those kind of numbers. I never will get those kind of numbers. But in our little sliver of the universe called options, I'm very happy with what we've done so far, and we'll see what the future holds for us. All this channel is, all we do here is free. I want to give you free education. All right, I want to give you free apps. I want to give you free goodies. For those of you that are getting started in trading, as well as those of you that have been around and known me for several years, and even the last couple of decades. I've been doing this longer than I haven't, so I don't know any other line of business other than the trading industry. Today, part two, we'll do a quick little review, and I mean quick. I want to talk about selling premium. This is something that I do. I do a lot of option selling. I do a lot of option selling and combining option selling with options buying. Because what I try to do is I try to create what I like to call a net neutral portfolio. I don't want to be too long anything. I don't want to be too short anything. I don't want to have too many options that I bought. I don't want to have too many options that I've sold. I treat my portfolio much like a hedge fund manager, a true hedge fund manager, not one who goes out there and buys a whole bunch of things expecting the markets to go higher, but a true hedge fund where you are hedging one instrument against another. And that instrument could be stocks, it could be ETFs, it could be options, it could be all of the above. So we're going to talk about selling premium today as part of our focus. That's a piece I want to talk about. Tomorrow, we're going to go through trading spreads. And on Friday, I'm going to talk about cryptocurrency. And I own a good bit of cryptocurrency as well. So everything I'm talking about with you is stuff that I do in my own trading. All right. And that being said, I want to let you know that some of the stuff I'm going to share with you today, I will let you know if I'm in it. All right. Full disclosure. All right. I want to do that because I don't want you to think that I am front running you. Front running is a style that some folks out there do where they take a trade and then they publish it. All right. We don't do that. All right. If I'm showing you an example, I'm showing you an example of something I have done. I'm going to let you know that. But I'm also going to have trade case studies, real-time case studies that I have not taken. All right. If I do take them, I will show them and I will take them in the most minimal contract with the most least amount of cost up front, really so that I don't want people thinking that I'm making thousands upon thousands of dollars off of trades that I'm sharing with the YouTube community. All right. I don't want to do that. I want to show them merely as trade examples to show you how I get in and out of these trades. Okay. Moving on. So what do I not do? All right. Probably should go through that as well. What do I not do? All right. Well, I don't sit on the side of hope. I don't sit on the side of fear, greed, etc. All right. There are plenty of folks out there that really push emotion in the markets. And emotion, well, it works every once in a while. Even a broken clock works twice a day. But the rest of the time, emotion, I have never made a career out of trading emotion. In fact, the very first time I started trading, which was in 1987, I was trading on emotion. And then October 19th, 1987 came along and showed me what emotion can really do to my portfolio. And I zeroed out. In fact, I went worse than zeroing out. So I'm not going to teach you a trading style that in my mind doesn't work. What do? We are rules-based traders. All right. We do a lot of things. We spot opportunity. We create low risk trades. We plan, exit, and manage trades. But think about rules-based opportunities. That's the part of what we do that I feel good about, that I feel unemotional about. I want to put these trades on and off. And if they make money, great. If they lose money, that's fine. I have accepted that loss ahead of time. That's where we take the emotion out of these trades, right? Kind of opportunities where I've spent years back testing, right? If it's a historical opportunity, I've done years of back test. If it is a statistical opportunity, which is what I'm going to talk about today, yes, I've got over a year at least in this strategy I want to show you, which is what we do with selling puts, and I'm going to share that with you. Okay, what's my track record like on this strategy over the last year? Over 90%. Over 90%. Okay, so I'm going to share with you a strategy that has worked over and over time with me on selling puts. It's not a get rich quick strategy. It's a get rich slow strategy. So let's do a quick review. Yesterday, I talked about why we trade options. I talked about option types. I talked about contract size. I talked about strike prices, expiration dates, which ones are the best, determined really kind of based on how you are as a trader. We talked about in the money, at the money, out of the money, and how I like to be a buyer of in the money options. I like to be a seller of out of money options. And I also shared two example trades with you on QQQ. I had a bearish opportunity on QQQ, not working out. I had a bullish opportunity on Bank of America. is working out. All right. So as we move forward, keep in mind, all right, I'm going to share a couple more opportunities with you. But yesterday I was talking about buying options. Today I'm going to complement that by talking about selling options, selling option strategies. All right. So part of what we're going to do today, folks, revolves around this free app that I gave out yesterday. I want to make sure that any of you that are here today that were not here yesterday get access to this app. Oh, by the way, if I ran a little too fast on that the review of options, it's because I've got this entire options part 1 live stream that I did that you can find right on the YouTube channel. Okay, so let's talk about this app. Google Play Store, Apple iPhone Store. You can download this app. What you're looking for is something called TG Suite. So in the search category, go and type in TG Suite. You'll find the TG Suite app. You'll then get it or download it, open it. If you're brand new to our tools, then what you're going to do is when you open the app, go down to the bottom of the app and it says non-subscriber login or not something that says non-subscriber. Click on that, enter very little information, and then you will get the app. And the app you're going to get is going to look like what I have in the middle of the page here. So if you don't use any of our tools, then the only one of these apps, because these are premium-based apps on here, but down at the bottom, you're going to see this thing called Morning Report. This is a very, very good app. It's absolutely free. It's something I use every single day in the morning before the markets open. When you click on that Morning Report, you're going to open up a list. You're going to have 6 different lists to choose from. Now, yesterday we talked about the cheap IV list. Cheap IV means cheap options. Cheap options relative to where those options on that underlying stock have been over the last year. So what we do is we look at options and we look at optional stocks, and we look at each optional stock and we say, where's the most expensive options been over the course of the year? Where have the options been their cheapest over the course of the year? And where are they right now? And then what we do is we get a gauge. It's kind of like a weather gauge. All right. What's the hottest it's been in your state? What's the coldest it's been in your state? And what's the temperature now? And is it close to cold or is it close to hot or is somewhere in the middle? Now we get rid of all the in the middle. The in the middle doesn't give us any implied volatility probabilities. But when options are cheaper, you need less of a move in the stock in order for them to gain value. When options are more expensive, you need a much greater move in the stock for those options to gain value. So what we like to do is buy the cheap stuff and sell the expensive stuff. Today, we're going to talk about selling the expensive stuff. I'm going to be utilizing this Morning Report. So check this out, guys. If you have not yet downloaded the Morning Report, check it out. I think you're going to love it. I'm actually going to do videos all next week on this. All right. All I'm talking about over the course of this week during our live stream are the cheap IV buttons and the expensive IB buttons. But we also have high volume options, high open interest, unusual call volume, unusual put volume. And what I'll do is I'll spend some videos discussing exactly how these work and then how we can utilize it in our trading. So let's talk about what we can do. All right. So when I click on, if I were to click on expensive IV, for instance, I'm going to have the ability to utilize that in today's live stream. So let's talk about market statistics. Very simple. All right. If you have a coin, think about this. Heads or tails. You flip a coin, unless it's a two-headed coin, there's roughly a 50-50 chance that that coin is going to come up heads versus tails. Now, if we flip that coin 10 times, what are we likely to come up with? We're likely to come up with 5 heads and 5 tails. We could have 6 and 4. We could have 4 and 6. We could have all the way up to 10 and 0 or 0 and 10. But the farther it deviates from one to the other, the less likely that's going to happen. And the more you flip that coin, the more you're going to come back to a mean reversion of 50% heads, 50% tails. Now, there are a lot of folks that look at the stock market this way, right? It's a noble way of looking at the market. It's called there's a book called A Random Walk Down Wall Street, which basically says in that thick book, you tear out the only page that's good about it. It basically says wherever we are today, that's the most likely place we're going to be tomorrow. Now, I believe in the fact that fear and greed drive the markets. And because fear and greed drive the markets, I don't want to add to the greed and I don't want to add to the fear. I want to try to exploit that. Now, as a market statistician, buying stock on this notion that I have right here, let me expand the page a little bit. Buying stock on this notion, to me, is not a great way to create reward risk ratios that I like to have. So by utilizing cheap options, we can buy options on this and we can actually have the chance to make more than we lose. But the problem is that we live in an environment where there are a lot of stocks that we might want to look at where their options are just too expensive. So what do we do there? Well, what we look to do there is we look at a process called selling options. And selling options to me, remember I said I like to be a buyer of in-the-money options and a seller of out-of-the-money options? If I'm going to sell out-of-the-money options, then perhaps I sell using the statistical probability approach. And that means selling options immediately gives you a higher probability. Think about this, all right? Let's take a look at let's look at an example right now. So I've got GameStop over here on the right-hand side, and GameStop's up about 3% today. We're going to look at AMC, which is absolutely going ballistic. But I want to hold off on that. AMC's up 55% right now. It just continues to gain volume. And anybody that has that hold on to your seat approach to AMC has done quite well, right? In fact, AMC gave me a bullish signal right here at 41.95, and we've just been cranking ever since. But let's revisit AMC. Let's enough of AMC for right now. Let's take a look at, and I'm using the Thinkorswim platform for this particular part of the live stream. All right. So I'm going to type in an option on GMC. So in order to do that with Thinkorswim, I start with a period. So .GME, that's GameStop, and I'm going to look at the June. So we've got June 4th options. They expire this Friday. So to start off, I'm going to use 21 for the year, 06 for the month, and 04 for the day. C for calls, and then look at where GameStop is right now, $257. Let's look at the 255 calls, if they even make them. Yes, they do. So here's your 255 calls. Check this out. On Friday, these traded as high as $34. Let's back this train up a little bit. All right, so let me go to hourly charts. There we go. Okay, so here's Friday. Now, check this out. Let's just blow this out a little bit. So Friday, the stock was trading at $268.80 as a high. It's at $257 right now, but take a look at what these options did. From Friday to all the way down to what you see here today. We've gone from $34 to $16. The options have dropped in half. The stock is almost where it was on Friday. That's because the options were severely expensive. Severely expensive. So what you see here is you see some options that are expensive that have decayed in value, right? Why? I think a lot of it has to do with what happened Friday afternoon when we went from 268 down to really down to this low Friday afternoon of about 221. You saw the stock go down from $34. The option went to $7. It's come back to 19, even though the stock has come back. And now we're trading almost back to 260. Look at those options did. They fell apart. Not the right way to play GameStop. Right now, if you own the stock, you're almost back to break even. But if you bought these 1-week call options, you're down by 50%. What we want to do is we want to look at a strategy where if the stock goes up, we make money. If it goes down, if we go sideways, we make money. If it goes down, we can still make money, right? And we got to do that by utilizing and harnessing probability and putting it in our favor. Put those odds in our favor. So that's what I want to talk about when we talk about if a stock's trading at 50. What if we were below the area? You know, if the stock was above 25 or the stock was above 75. All right. If the stock's above 25, if it's at 50 and we hold it at 25, there's a higher probability it's still going to be above 25 come this time next week, next month, next year. But if the stock's at 50 and we are looking at it to be at 75, there's a lower probability it's going to be at 75 this week, this month, this year. These are called probabilities. It's a lot like rolling dice. So let's be the stick man. Let's be the stick man of options in selling strategies. So the spot selling opportunities, this is what I like to do. I want to run a scan first on what I call IV percentiles, i.e. optionable stocks that are expensive. All right. Next thing I'm going to do is I'm going to look at those case studies, and I want to look at something called probability charts. And I want to put myself just outside of the cone, of the probability cone. And then finally, I'm going to look at option prices, and we're going to create trades that we can sell puts on. All right. That all starts again with that morning report. Now, I've blown up the morning report for everybody to take a look at. So let's take a look at it right now. So again, if you're new to this, it's a new app. It's called TG Suite. And what you're looking at when you download TG Suite, there's a lot of different apps within the TG Suite. Most of these you may not be able to use because these are premium apps. But the one that everybody in the room can use is, check this out, the morning report. When you click on that, by the way, if you're a user of our software, all you got to do is just log in. If you already have TG Suite, then update to the latest one if you haven't already, and you get the morning report. If you're brand new and you don't see it, then take a look at down at the bottom where you log in. It says non-subscriber login. So log in there, and then once you fill out the information there, you'll then have access to the morning report. The morning report will give you these lists. And then what we're going to do is we're going to click on the expensive IV list. Now, I've already blown this up and put it on the screen so everybody can see it. Yesterday, we talked about cheap options, and there is a list of new cheap options today. But today, I want to focus on what I've highlighted. What I've highlighted are the expensive options, the options that I want to look at selling. Okay, so we take a look at these options that we're selling, and what I want to do is I want to take a look at these options, and they're in an order of which ones have on a percentile are the most expensive. So VRTX, definitely going to take a look at. We could take a look at SSCO, BIIB, AMC, going to take a look at. And I can tell you that implied volatility is higher right now than it was this morning. So that one's definitely, the options are getting more and more expensive. TAL, SPLK, BIIB, I have a trade in right now. I'm going to use that as our example. All right, I'm going to use that as an example. I am short puts on BIIB. Just want to throw that out there right now. It's still coming up. I had put on some trades on BIIB last week, which are profitable. I put some more trades on recently, selling some more puts. And so I want to make sure that you all understand that one I'm in. I'm just going to use it as an example. But we're going to take a look at one or two others and see what is shining out there in terms of option selling strategies. There's plenty of them to look at here. All right. Hey, while I'm before we jump into these, for those of you just joining us, and I see the clock, the number of folks on is getting higher every moment. I want to let you guys know. First of all, welcome to our part 2. All right. Today, what I'm focusing on is stocks, calls, puts, and really selling options, and to create that premium and create, again, that high probability trade. All right, that's what we want to look at. I want to thank all of you for being subscribers. For those of you that are subscribers, we're doing, as a thank you, we're doing a couple of things here. First, I'm doing live streams all week. All right. I'm actually taking my Optionetics Trade Essentials, which is typically a 3 to 4 week webinar. I'm doing it all 4 days this week. And the second thing we're doing is we just launched a new app, and I wanted to make it available to our YouTube community, which I did yesterday and I am today. So check out, go into either your iOS or Google Play Store and do a search on TG Suite. Download that. If you're not a subscriber, go down the bottom where it says non-subscribers and then fill that information out, and you get the morning report absolutely free. And that's what we're using. That's what's on the screen right now. Okay. So from this point, let's take a look at some of these. So what I do is, let's start with Biogen. Now, the one thing I want you to know about Biogen, and I snapped this chart so that I could go through this process, but the rest of the time, I'm actually going to be going and using our tools, and we're going to find these things on the fly. But if you take a look right now, you see what's going on with this chart. Look at this chart. This chart is absolutely beautiful. The chart's moving sideways. The candlesticks are in a range. The low end of this range is 250. The high end of this range is 295. But look where it's gone since then. It's actually gone into a range where we've seen this 250 to 295 high to low has been sticking for the whole year. Since the 8th of January, it's been sticking. Now, I want you to look at this black line here. This black line is all the options crammed together. The 7-day ones, the monthlies, the quarterlies, the ones that are out 6 months or so, all together. We cram them all together. What we did was we smooth them out. We look at those near money options, and we look at those option prices, and we actually tag a number on it. We call it implied volatility. All right. And we actually track this number every single day as a unit of measurement. So when you see this is not a moving average. This is what the option traders are paying for their options. And look what they've been paying for their options over the last month. They've been going higher. So if you've been a buyer of calls or puts on Biogen, this has worked out very, very well. But look how expensive they've gotten. It is safe to say that buying at the money calls or buying at the money puts on Biogen is going to cost you more than twice as much as they cost just a little bit more than a month ago. Now, that's like going to the gas station and filling up your tank and paying twice as much per gallon for gas. It's still gas. It's still going to get you the same tank full. You're only going to get so far in a tank. Whether that tank cost you $2 a gallon or $4 a gallon, or in California, probably $7 a gallon, we know gas prices rise and fall. We look at this the same way, all right? And we want to sell these gas prices. We want to sell this premium. So to sell put option premium, I do something I like to call it cash secured selling. All right, there's two ways to sell premium out there, just flat out selling, all right, without spreads. Number one, covered calls. Covered calls mean you need to own the stock and you sell the call option against the stock. That's one way of selling premium. And naked puts. I like to call them cash secured puts, which means any put you sell, you're able to back it if you end up buying the stock. I'll get into that in a few minutes, but cash secured puts is another way. They both represent the same thing, the ability to take in premium on an underlying stock, right? So this is the next chart I look at. So number one, the options are expensive. How expensive? Well, if they're above their mean average, they're expensive. The higher they are above their mean average, the more expensive they get. Now, this chart right here is a chart of Biogen, but what we're doing is we're using, let me back up. We're using this big line here that's gone up, this option premium that's gone up in value. We're using that line, and what's happening is we're creating a probability cone based on these options. And the probability cone based on the option premium gives us an idea of where the stock is likely to hold if it were to break above or go below current prices. All of you that are watching this can see two cones. You see the blue cone, you see the red cone, okay? I'm not taking the blue pill, I'm not taking the red pill. This is not a movie, right? The blue cone represents a 68% chance going forward in time. So here we are. This is today. This is 60 days from now down here at the end of the chart. As we move forward in time, the blue cone suggests that there's a 68% probability that Biogen is going to stay inside the blue cone. Now, the next standard deviation, that's what these are called, creates a cone that has a 95% probability of staying in the cone. Now, when I say 95% probability, that means there's a 5% chance that it's going to be outside of that cone one way or another. Now, there's two ways immediately that I'm looking at that I could profit from this cone. And that's simply to sell out of the money calls below the cone, out of the money puts below the cone, out of the money calls above the cone. I could even do both. Here's the problem. Selling out of the money calls gives me a fixed income, but it gives me infinite risk. Selling out of the money puts give me a fixed income, but it also could give me an unlimited return, unlimited profit potential, and a limited risk. Now, some of you are going to argue with me on this. You're going to say, no, Tom, that's not the way it works. Put selling has limited risk and it has unlimited reward. No, it doesn't have unlimited reward or unlimited risk. The risk is limited to the stock going to zero. The reward is unlimited if you hold the put and you are assigned the stock. I know this because one of the stocks that we discussed quite some time ago was, this was one that was a tough one to get into. All right. It was one of those old retail Ross stores. Remember Ross? Remember, it was one of the other ones too, CPRI, which is a Capri Holdings, which also holds some of the lower retail type of companies. And that thing was trading around 20. And we were looking at selling the 15 puts. And the 15 puts ended up getting assigned because the stock went down to $14.98. And then the stock was assigned and the stock ran up. Well, CPRI has gone up into the 50s and beyond. That's what I talk about when I say unlimited long-term reward. So you can use this particular strategy two ways. You can use it as a short-term income strategy. You could use it as a way of buying stocks below market price and getting paid to do so. Right? I'm going to show you both of those ways today. But part of what I do involves placing my trade just outside of these cones. So, if you're looking at Biogen, take a look at Biogen. I'm actually going to come down and take a look at it here. So if I were going to place a trade 30 days in the future, let's say I'm looking at the 35 days, whatever, July, and I look at the cone and I see that based on the implied volatility I'm looking at, that if I want to be on the safe side, now, no guarantee, but if I want to be on the safe side, I want to be looking at selling puts below $225 per share. This stock's trading at almost 270. So I wonder what the 225 puts are selling for, the 220 puts are selling for, maybe even the 200 puts. All right. So step one, I look at those high IVs. Step two, I want to look at the probability cone and see where we are. Step three, let's look at the options. And this was the most recent option chain I pulled just before our live stream. I wanted to put it up here nice and bold and show you what I'm looking at. Look at these 200 puts. This is the July 16th puts. They expire 44 days before expiration. So they are in the 44-day area. So if I back up a moment, you see 40 days? Look, here's about 44. So we're really right around 200 and let's call it $220 on the cone. The probability cone. Guess what? We don't need to be rocket scientists to figure this out. My tools have put all of this in place for you so that you have the ability to go out there and find these cones. All right. And we do have, by the way, on the description below, for those of you that are brand new, we do have a 2-week free trial to tomsoptiontools.com. So check that out if you've never used our tools before. All right, so I'm looking at this. I'm saying, all right, 200 puts, $3.65. They're 340 by 390. So 365 is the midpoint. Let me ask this question here. as I'm looking at comments coming across the screen, and thank you all so much for the comments that you have. Take a look at the board right now. See that 340 by 390 and see 365 in the middle? How many of you have placed an option trade, whether you bought an option or you sold an option, and you actually got filled in between the bid and the offer right after you placed that trade? Who in here's done that? Is it even possible to split the middle? That's the question I ask all of you right now. We got a lot of people in this room. So, hey, make your voice be heard. Tell me, how many of you in here have been able to split the difference? Yes, no, maybe so. I'll tell you, while I'm seeing seeing all the comments come in, I'll tell you what I see. I know this. When I place an order and I hit that buy button and it sits, then I know I'm in an area where I may not get filled. I had to do that a couple of times today. Let me tell you this. If I ever placed an order and I got on an option that wasn't really, really liquid, and I got filled instantly after placing that order on the middle of the price, that wasn't the mid price. I just got suckered in, which is why I do the majority of my trades. I do them on, I really do them on the most liquid stocks available, the most liquid optional stocks available. We talked about this yesterday, all right? These are limit orders. But when I'm looking at Biogen, some decent movement there, right? So what I'll do is I'll go out and step one, high IV. Step two, what's the cone look like? And can I sell puts below the cone? Step three, what do the options look like? Can I make anything out of them? And so step four is I go to my broker's platform and I go to place the order if I like what I see. And before I place the order, I go and look and see, all right, if I'm selling to open these 200 puts, these are July 16th, 200 puts. Stock's at 270. You're getting a 30% off. You're selling this 30% below today's stock price. And you're able to get 320 by 390. Now, that was the updated quotes I saw. So 355. So can I get 350? I like 350. 350 could be doable. So that's where I go in and place that order. Now, keep in mind, selling to open is how you create the trade. You're selling the trade first. And to me, my goal is to never buy it back. My goal is for it to expire worthless and I keep that credit. But I could be put the stock. I could have the stock put to me, which means I then own the stock, but I'm happy owning the stock, a $270 stock at a price of 200. Even if the stock goes down, and even if it goes a little bit below 200, better than owning it at 270 today. That's what I say. So this is how you place that order. You sell to open. I always do these at limits. And then day only orders, because I'll come back and take a look at it. If it doesn't get filled, it's canceled at the end of the day. And I'll look at it again tomorrow if it makes sense. Now, how to own stock and get paid step by step. Once again, selling put options. Well, they do obligate you to buying the stock at a predetermined price at a specified time. That's what the strike price is. That's what the expiration date is. You get paid that premium, that $3.50, that's $350 per contract that comes in. But I'm obligated to buy that stock if it drops down below my strike price at expiration date. If we're below that at or below the expiration, the strike price at expiration, I could end up owning that stock. So just keep that in mind, guys. Okay. What's it cost to do something like this? That's a question that comes up all the time. And that has to do with what's called margin. Now, margins are going to vary at different firms, but I usually factor in about a 20% margin on puts on average. You check with your own broker to make sure that that's correct. Some may be more, some may be less, but 20%. So what's 20% of 200? It's 20% of the strike price. So 20% of 200 is 40. So in order to capture $350 in premium, I'm going to need to pony up some money. All right, $4,000 in margin to be able to put that trade on. But I'm getting paid a good 8.5% on that trade over the course of a month. That's the way I look at that. I look at that 8.5%. I'm getting that. I'm getting that no matter what. I'm getting that if the stock goes up. I'm getting that if the stock goes sideways. I'm getting that if the stock goes down. If the stock goes up, the put decreases in value. I just keep it. If the stock goes sideways, the put still decreases in value. I'm still going to get it. What if the stock goes down? Well, if the stock goes down, let's say the stock goes down to 190. Well, I now have to buy a $200 stock that's trading at 190, but I still get to keep the $3.50 premium per share of stock that I brought in. So if you take a look at 200 as a strike price, take $3.50 off, that's your break even on the trade. All right, so let's do a step-by-step, and then we'll look at some real trades. So step-by-step, again, I'm selling. If I sold one BIIB, one Biogen 200 put for $3.50, it obligates me to buy Biogen at 200. I get paid $3.50 a share to do so. Again, if the stock remains above the $200 strike by expiration, I keep the amount received. If stock goes below, I still keep the amount received, but I'm also obligated to purchase the stock. So understand your obligations ahead of time. All right. Now, Robin, you're asking, does it mean we should only use the strategy if we want the stock? Not necessarily. You could bail out early if you don't want the stock. A lot of folks do this. A lot of folks, I mean, I do it on, some of the bigger name stocks, and I'll just show you an example of some of the ones I've done in the past because their volatility was quite high. We'll take a look at one right now. This is not one I wanted to talk about, but I'm going to bring it up anyway. All right, because we're at the case studies part right now. So, if you take a look at, for instance, I know people that do this almost religiously on Amazon, on Apple, on the FANG stocks. All right, some FANG stocks give you more juice than the others. Usually Amazon and Tesla are the big FANG stocks. And so if we were to look at Amazon and Tesla, you'll find that, and I like to look at them when they're IVs are high. The other thing you can do too is that, here's another idea. If you're selling puts, is that not a directional trade? You would love the stock to be bullish, right? So what if you sold puts in conjunction with a seasonal strategy? One of the seasonal strategies I use is the money calendar. We showed it yesterday. What if we did it with a contrarian trading strategy? What if we did it with looking at Fibonacci, for instance? If you're looking at Fibonacci buys, if you're looking at new highs in the market, if you're seeing something that's making new high after new high, why not sell puts then? That way, if it comes back, you're taking advantage of the drop in premium, not the drop in premium against you like the call buyers are dealing with, but the drop of premium in your favor if you have puts happening. So, can you sell naked puts? Yes, you can. All right. But you got to realize that comes with margin, and you need to know what that margin is ahead of time. So I'm going to share with you what happens and what would happen if you sold an Amazon put. All right. So let's pop over and let's look at some case studies right now. So what I'm going to do is I've got my expensive and cheap morning report. By the way, the morning report is also available on our tools, not just on an app, but if you're a tools member, this is available on our option tools, and you can get to it right up here under options, and then you can go to rankers, and then down here at the bottom, you see morning report. All right. So that's where it's available right now. I'm just going to put today's morning report there ready to go. We have the other ones too, the unusual high and call and puts, and we also have the high open interest and high volume. So let's stick with what we're doing today. Expensive over here on the right. Before I get to these, take a look at, let's look at Amazon real quick. So let me go to a stock chart. That's a stock chart I want to get into in a moment. Here's BIIB. Just did this. Let's go to stock charts. And let's not look at Biogen because Biogen's already there. Amazon, right? Here, this is going to be good news, bad news for those of you that look at Amazon. Let's blow the screen up. Here's Amazon. Now, look at Amazon's options volume. See what's going on with it? It's dropping. It was rising heading into earnings, but since the earnings reports come out, it dropped down. It rose up a little bit, and I believe that if we keep going down, it's going to rise up again. But we're talking about something that was trading in the 30s that's now trading in the 20s. But when you look at Amazon's when you look at Amazon's options premiums, I mean, they're expensive. Let's just hop on over here. Let me show you what I'm talking about. So let me clear out the board. Let's type in AMZN. All right. Now I'm going to select a put on Amazon. And again, how would I do this? I would go through and I'd look at that stock chart of Amazon. Remember the stock chart? Here's Amazon. This is the chart. But then let's just see what the probabilities look like. So I have a probability chart. I'm going to put the cones up right now for Amazon. And if you take a look at the cones, I've got the cones going at 60 days. And I can change that. Let's just look at the next 30 days, or I'm sorry, 44 days. That takes us out to mid-July. Here's the cones going 44 days out. So the cones are saying, hey, if you want to sell puts on Amazon, you really need to look down here. You need to look down here in the, oh, no, I'm using the 100 standard deviation. I only need to use the 20 standard dev. All right, it's going to make a little bit shorter of a cone. So the cone says, hey, look at the 2784 area, all the way out here to the 44 days. So then 2784. So let's look at 2780 puts. So I'm going to go out to July 16th, and I'm going to look at those 2780 puts. There's the 2750 is as close as I'm going to get. See those puts? $10.60 by 11.15. Let me blow this up so you guys can all see that. 10.60 by 11.15. If I were going to sell that put, this is what it looked like. Sell to open, 1. Now, stock's trading hundreds of dollars above that. Where's the stock at right now? Stock's trading at 32.30. That's like $500. That's $450 higher than it is right now. That's incredible. So what am I going to get for that? I'm going to get $1,000. I'm going to get, if I could do this for $10.80 for a contract, I'm going to get $1,080 for this put. But what's going to happen? What's going to happen is when I want to place that order. So if I come down and I preview this order, here's what I'm looking at, guys. The margin is going to be $27,000 to take in $1,000. All right. So that's the thing you got to think about is, what's this going to cost me? My margin is $27,000. I'm not taking in 8%. I'm taking in very little. I ain't taking in maybe 4%. But we can find better opportunities out there. We can find much better opportunities than Amazon, right? Especially this is something that goes all the way out to August, right? So let's set this up and get ready. By the way, I'm using Street Smart Central. Let me mention this. I don't recommend brokers. I recommend you do your own homework and find a broker that works for you. You will never hear me on my YouTube channel or anywhere else. You're never going to hear me say, here's a link below. Open a trade, get a free stock. I don't do that. All right. I'd rather you find what works for you. All right. Find what works for you. It's really important. This is this is your money you're dealing with. I want you to find what works for you. I have a handful of brokerage accounts that are out there. This happens to be one of them that I use, is my Charles Schwab account. But let's move forward. Let's take a look at back to our screen. All right, and I'm going to back up and I'm going to look at that those expensive options again. All right, so let's get to that expensive tab. There it is, VRTX. Let's look at VRTX. So I got VRTX here somewhere. Here's VRTX. Take a look at Vertex. This is a chart that goes back to the beginning of the year. Oh, let me blow it up for you. Low implied volatility is down here near the bottom. All right. The options were trading down here at a 30 percentile, moved as high as the 55 area, trading right below 50 right now. So it is much higher than it has been lower. It's on the expensive side. Everybody sees that. So from there, what I can look to do. Now, the earnings are in 57 days. The earnings are scheduled to come out on July 29th. Even if we went out and looked at the July options, we could be out of those third Friday options in July before the earnings come out. By the way, the last time the earnings came out, the stock did it took a couple days, but it went from 230 down to about 210 within 2 days before slowing down. So it gives me an idea of what can happen after earnings. But right now, it's just kind of been caught in what looks like about a 25-point trading range. I like it down here near the bottom. So let's take a look and see what the options look like for Vertex. So I'm going to click on options. I'm going to go to option chains. All right. And I'm going to look at the option chains. You know what? Before I do that, let's go back to the stock chart because it's important for me to go to step 2. I went from step 1 straight to step 3. My bad. I want to look at that probability cone. So the stock chart I want to look at is the probability cone chart. Let's take a look at it. And here it is on the screen. And this goes out 60 days. I really only needed to go out 44 days. That's to the July expiration. You can see the same thing I saw earlier. Caught in a trading range. Look at the probability cones. Take us down to 176. Well, the 175 puts are closer. So let's take a look at the 175 puts for July. 175 puts for July going to look like this. Options, option chains. Come on down, and I've got to go quite a bit out of the money. 10% ain't going to be enough. Let's look at the July 16th options. There they are. Those are the options. They expire in 44 days. There's 36 different strike prices out there on them. So I'm going to look at those, and I'm going to look 30% above and below the stock price. What I want to do is I want to see that 175 area. There it is. So we're not even 30% away, but they're trading for 90 cents by $1.15. That's what I see right now for the 175 puts. Okay. So I got to ask myself the question: Can I get $1 for these? It's typically the minimum I'm looking for. Can I get $1? If I can get $1, then I might be interested in doing this. So guess what? We're going to come over. Going to clear the board. Going to look at VRTX, Vertex Pharmaceutical. By the way, all the pharmaceuticals all pumped up in IV. It happens to do with a little thing called coronavirus or COVID-19, if you want the politically correct name for it. Puts. Remember, stock's trading at 207. I want to look at that at a percentage off. So we're going to look at the 175s. 175 puts, not the ones that expired this week, the ones that expire on the 16th. And if I sell to open these, can I get well, they're 90 cents by $1.15 still in the real time. So can I get $1 for them? That's the thing. And I want to sell to open these. All right. Sell to open for $1. Now, just for front running purposes, I don't want to put on more than one contract. All right. $100 is not going to make or break me at all. So I'm not going to go putting on a whole ton of these and then tell you to do them. I'm going to tell you that I'm going to put one on to show you how it works. And I'm not going to tell you to do this, right? Because these are not personal recommendations. I'm not your investment advisor. I'm merely showing you how, again, spot opportunities create these either low risk or high probability trades. Plan, execute, manage. All right, so selling to open this. So if I preview this, what I'm really interested in is it's going to cost me almost $5,000 to bring in $100. All right, $5,000 to bring in $100. You know what? That's not enough for me. What's 10% of 5,000? 500. All right, what's 5% of 5,000? 250. I mean, they're asking me to take 2% in on the margin, 2%, and hold that trade. Not worth it. So even though we find expensive options over here, they might not be as expensive enough for me to get really what I'm looking for in terms of risk to reward. All right. GD Blue replays. All you got to do is go back, and when you go into YouTube, all you got to do is just go back. You could find yesterday's live stream. I think it's under live, is what I believe. So that's where you'll find any replays. They're there. All right, Jim, I agree. 2%, lousy. All right, so let's go to the one I really want to look at, or the two I really want. I mean, BIIB was a great trade, but look at AMC for a moment. This one's going to be one of those, because it's moving around so much. So let's look at AMC. AMC, I've got to update because it's moving so fast. So here's my probability cones for AMC. I've already kind of got the probability cones up and running. And it's just, it moves around. Now, why are the probability cones on AMC so small? Because I'm looking at a 2-day trade. We can look at a 2-day trade. We'll look at, next week. We'll look at next month. We'll look at 3 different examples. All right. So percentage calculation on the probability cones is the blue cone gives us statistical probability that we're going to stay. We got a 68% chance statistically we're going to be inside that blue cone. We have a 95% statistical probability we're going to be inside the red cone 2 days from now. But keep in mind, we're dealing with a stock that's, it's like grabbing a tiger by the tail. I laugh when I say that because just a couple of weeks ago, the stock was trading at 10. And it just hit a high of 60 because everybody and their Reddit brother and sister are all over this thing. I can tell you it's going to come down just as fast as it goes up. But what's it going to do in a couple of days? Okay. What's it going to do in a couple of days? Well, what we're going to do is we're going to attempt to look at this and attempt to put a trade on that has a couple of days on it. So let's look towards, I want to look at my stock charts. I'm actually going to come over to stock charts here, and I'm going to change this to AMC. All right. And we're going to go from the cones. These are the 30-day cones. Take a look at this cone. Notice how it whips out. All right. That's not linear. That's a logarithmic cone that whips out that just tells us that AMC, based on what it's done, is likely to go much higher as a dollar move than lower as a dollar move, because as it gets higher, the same percentage yields a greater number. As it gets lower, the same percentage yields a less number. I would not want to short this. I would not want to short this. There's too many hedge funds that have learned the cost of that, that cost of cost of that. So let's take a look at the put side and see what's going on with it. All right. So option chains, AMC option chains. So take a look here. We can't go 10%. We got to go like 50%. 50% looking at those June 2nd options. So what this means is when I look at 50%, that means I'm going up and down 50% from where the stock is right now. That's what I'm looking at. All right. Back it up. And let's take a look at what these option strikes look like. Here's the put options. Take a look at this. Now, these are going to be wide. So limit orders are a must. There are 23,000 open interest. That means there's 23,000 contracts that are traded on this. Okay. Volume over the last day was 7,300 contracts. That was at the strike price of 27. These things are 63 cents by $1.70. Somewhere around $1 might be an interesting trade there. Now, let's see what $1 looks like on Street Smart when I go and look at this on the platform. AMC. The question is too, can you even do it? Because last time, it was months ago when I tried to trade AMC, I wasn't allowed to because the broker shut me down. But maybe we can today. So if I go and I sell to open, and I'm looking at not the 57 puts, although those are very juicy. What about the 27 puts? What are they trading at? They're trading 54 by 58. So they're coming a little bit closer together. So let's go back and take a look one more time at this chart we see here. All right. And we're looking at, I'm calling it user defined, the 3-day chart. Let's look at 5 days. Let's go out 5 days on this. Now, the farther out in days I go, the wider this graph's going to get. as you can see here, I mean, this is a one-day move. I want to see something that looks the cone future days. I want to see cone future days that go out quite a bit more, because the cone volatility is based on 168. I need to set the cone volatility, to 250, because that's where these options, these option volatilities were, right? And if let's go back and look again. Take a look at the IV, 263. Do you think the IV's gone a little bit higher today? Yeah, 300, 350. Let's take a look and see what that does. So I can set the IV, the cone volatility, based on current IV. And if current IV is trading at 350, then I want to know where this thing's going to move in a couple of days. And I've got 5 days on here, but we really are going to be looking at 2 days, Thursday and Friday. That's tomorrow and Friday. And the cone volatility still shows 35. All right, so 35, but maybe we want to go down. Let's take a look at the 30s. So let's look at the 30s and the 35s. The 30 puts, where are they at? They're 86 by 88. The 35 puts, where are they at? Wow, 182 by 185. This is actually not bad. Because if I go in and I say to myself, wow, 185 put, I mean, let's say that I throw some limit order out there and I try to catch 2 on the way down. What if I sold one of these for 2? What would I get? Let's do the preview. All right. My account's not approved for this option strategy. Can you believe that? And this is what you got to check. Somebody's got me, because I could sell puts on Amazon all day long. $3,200 stock. I can't sell puts on AMC. Let me try something. What if could I sell calls on AMC? Let's see if I can sell the 56 call. Preview, sell to open the 56 call. Let's put a limit price in. Let's try to sell it for $15. Even though I'm not going to get that right now. I just want to see if I can do it. Not approved. Okay, so what has happened? What's happened is, because the volatility in AMC is so high, this particular account will not allow me to trade it. So I'm going to have to go to one of my other accounts. So you need to see whether or not your broker will allow you to actually even do this. But there is one more I haven't looked at. What about a strangle? All right, a strangle is the ability to sell calls and puts together. Delta neutral strategy, taking a little more premium. Maybe I can slide it in that way. Let's take a look and see. So if I were to sell to open, what was the strike I was looking at? The 30s or the 35s? Not the 35 call, the 35 put. Was trading at, okay, here we're now at 174 by 177. What if I sold the 73 is as high as you can go. I wanted to get higher. I want to get up to that 100. But let's just see if they'll even let me take this trade. I'm not going to place it because I don't like this this particular trade. But if I preview this, let's go ahead and put a limit order in. Let's put a limit order in of 15. Uh-oh. So they won't let me sell the put, which has limited risk. They won't let me sell the call, obviously, because it has unlimited risk, but I got plenty of money in my account to do the others. But they'll let me sell the strangle. Go figure. You know what the next phone call I'm going to have is? As soon as I get off the phone, as soon as I get off this live stream, the next phone call I'm going to have is going to be to Charles Schwab. Not Charles Schwab himself, but the brokerage firm, to have them try to explain to me what in the world are they thinking. Anyway, guys, selling puts work. You can see that in some cases I'm able to put these trades on, and in other cases I'm not. But what I look at to utilize the sell put strategy is I look at expensive options first. Remember, then I look at probability cones. Then I look at the option trade that sells, and then finally I try to see if I can actually place the trade. I've done that before. As you know, I used an example with BIIG. BIIG, I'm actually in. Sell to open, enters to trade. Someone was asking about exit strategies. Well, I like to let these expire worthless, but let's say that I took 80% of this credit. If I took 80% of the credit, what would I buy it back at? If I got filled at 350 on this Biogen 200 put, what would I buy it back at? If I want to take 80% of the 350, I would buy this back at 70 cents. Take the 80%, send the 20% back. A lot of you out there do nickel or dime buybacks. That means if it goes down to a nickel or a dime and you got a couple weeks to expiration, you know it's not going to go to zero for 2 more weeks. Why not sell it? Pull the capital back in, redeploy it somewhere else. I like that idea too. All right, so those are some things we could do as well. Again, I talked about step by step, selling, what you're obligated at, and what to do. All right, and in all of these circumstances, you still end up, if your intention is to keep to keep this, your intention is to absolutely, you could keep it. You could keep that profit and move on. Right? We had some case studies. Some of them work, some not. Let me give you some short put entry and exit rules. So short put entry and exit rules. Well, entry, stocks you want to own. 60 to 90 day options will give you the most premium. I look at those probabilities that are greater than 90%. It's very easy. Stay outside the cone. High IV is going to be in the high range. I call them the high ranger IVs. Use that free app. Use that free app I gave you. That allows you to get in there and look at those high IVs. You know what? Let me try one of these on GameStop too before we end out our day. And a bonus is if the stock's above its 200-day moving average, then at least you got something that's trending in the right direction. All right. Let's go ahead and look at GME and let's see if they'll let me do this on GameStop. All right. So one more time. Here we go. Let's roll on out. Let's take a look at GameStop. So how do we do this? Remember, we're going to take a look at first a stock chart. Let's get rid of AMC. Let's get into GME. Not moving like it used to. It is quietly getting up there to those highs once again. But let's look at some probability cones going out 44 days to the July expiration. So 44 days out, we've got some probability cones that look rather interesting. And that's crazy. But that's also based on, remember, I'm basing that on something that we don't have high IV like we do in AMC. So I got to change the IV on the cone. How do you change the IV on the cone? Well, let me show you. Let's first go back and let's look at the stock chart. All right, we're going to look at the stock chart. Chart type, I'm just going to look at stock. And I want to look at that implied volatility, 40, that 30 to 60 day IV. There it is. Let's bring it up. Let's take a look at it. So what it's telling me is right now, the 30 to 60 IV on GameStop is at 178. All right, so 178 is what I need to use. So let's go back to our probability cone and let's put in a 178. All right, so 44 days in the future, cone volatility, 178. Let's get some real cones. Let's get some real cones. There's some real cones. Look at this. That cone 44, looks like 90. Looks like 90 is where we're at, that 90 to 100 area. Let's jump over. Let's clear the board. Let's put in GameStop. Selling puts on GameStop. All right. GameStop to the moon. The Mooners got to love me on this one because selling puts is being long on GameStop. So here you go. Selling puts, GameStop, sell to open. What am I selling? Well, the 272s, this is with a couple days to expiration. You're going to get about $20 for those. That's 10%. That's interesting. I like that kind of 10% of that price. What about the 250s? Just for the 2 days, just 2 days. Wow, still going to get almost $9 to sell the 250. But I want to look at the 44-dayers just a moment. So you can look at this short term. Let's look at the 44 days out. I haven't even checked to see if I can do this yet. They may blackball me again and say, nope, you can't do it. Let's find out. $51.73 to get the 250 put. Wow. That's amazing. But the 250 put, I'm not interested in. I'm interested in the 100 puts. The 100 puts going out. Okay. 100 puts. Guys, $3.50 is the bid. 363, 375. If I could do the bid for $3.50, I'm just gonna throw this in here. We'll do a little talking here. 350 brings in $350 on the contract. It's good for 100 shares of stock. That's $350 premium. To obligate you to buy the stock at 100, it's at 274 right now. 100. $3.50 is 3.5% on the stock. But how much is it on the margin? If the margin on this trade is going to be $2,000, then you're getting a really nice return on the margin. Let's do a preview and let's see what this looks like. Nope. GameStop is also one that I'm not allowed to do the strategy on. Okay. But I want to leave you with this. What could we do with a GameStop or an AMC that would allow us high probability? Please tell me. Tell me. What can we do? What can we do to allow ourselves high probability, but not end up with something you just saw where they won't allow me to put the trade on? Naked call. No, I don't think I can. Harmon, thank you so much for that donation. That's going to go to a worthy cause. All of our proceeds that we do on this channel go to charity. All right. So thank you very much. DN, sell put spread. Brent, put spread. Joe, call spread. If you really think it's not going to go any higher, that is a correct answer. All out of the money spreads do come with higher probability. All right. Higher probability. So that's what I wanted to teach you here, guys. So, if we just do a quick little summary here, keep in mind, these are the things I'm looking at, that I look at when I'm looking at selling puts. First of all, put selling has less cost and risk than buying the stock outright. It also gives you an instant payday. All right. Keeping that payday means holding on to that position until that payday expires worthless. Put selling has a higher statistical probable outcome than buying stocks. Put selling at its worst case allows you to own the stock below original market price. And using expensive options gives you more premium, but could increase the risk due to future stock volatility. All right. We've talked about that. And I want to finish off where I started, guys. For those of you that came in late, all right, we had a free app giveaway. And I want to make sure you know about this free app giveaway before you go away. That free app giveaway is a new app we created called the TG Suite. Now, the TG Suite we've had for a while, and we have a good half a dozen premium apps in there that are part of our tools and part of our some premium products that we offer. But that one down at the bottom there called Morning Report, that's available to everybody. Okay, that is available to everyone. So keep that in mind. As we move forward, all you have to do to get that app is just simply go out there and download it off the iPhone or Google Play stores. Set it up. If you've never used our tools before, down the bottom, it says non-subscriber. Click here, and then that'll allow you to have access to the Morning Report. Once you open up the Morning Report, you will then have access to these 6 lists. I've talked about cheap buy V list yesterday, how to buy cheap applied volatility. And then on the turnaround today, we talked about selling expensive options volatility. All right. So guys, before you bail out on me today, tomorrow, what I want to do is I want to do a little review of part 1, a little review of part 2, and I want to get into spreads. All right. So we kind of talked a little bit about spreads here just a few moments ago, but I want to spend a live stream tomorrow talking about spreads. All right. Also, we'll go over all of our option trades that we're looking at and see where they are. All right, we'll see what's going on with Qs, what's going on with BACs, what's going on with some of our put plays as well as some new plays that we have going on. Guys, if you're just new to the program and you find this educational, I want you to do a couple things for me, please. All right, number one, would love it if you'd go out there and hit that like button. Smash that like button. It really helps support the channel. Also, by sharing this channel with others, especially those that are new to the world of stock and option trading. hopefully you'll find that I can give you some guidance and education toward how to do this right, the rules-based trading way. And then finally, by subscribing to the channel and by dinging the bell, you'll get everything that we launch on the YouTube channel before everyone else does. All right, because you'll see it, because we'll notify you of that. So, guys, thank you very much. I appreciate all of you hanging out with me here, and I will see you again same time tomorrow. Till then, have a great rest of your day. We'll see you all. Bye now.